This is David Russell, Global Head of Market Strategy for TradeStation. And today we'll look at major events for investors and traders. Some investors have worried that overconcentration in large growth stocks could hurt the broader market. Now it might be coming true. The S&P 500 fell almost 2% between Friday, July 12th and Friday, July 19th. It was the first drop in 3 weeks and the biggest decline in 13 weeks. Technology stocks led the selling, especially semiconductor companies like Advanced Micro Devices. Oddly, more index members rose than fell. That suggests money could be shifting from large stocks to smaller corners of the market. The big move started on Wednesday with fears that the White House will restrict chip-related trade with China. That helped confirm a bearish technical pattern from July 11th, when the Philadelphia Semiconductor Index was rejected at an all-time high. Some of the price action also seemed like a reverse of big gains during the July 4th holiday week. The second big event was on Friday after cybersecurity firm CrowdStrike caused one of the biggest computer outages ever. CrowdStrike, which only joined the S&P 500 in June, had its sharpest weekly drop in almost 2 years. Those two items erased more than a month of the Nasdaq 100's gains. Strategists at Goldman Sachs warned a pullback could be starting based on fund flows and seasonality. Ryan Dietrich at Carson Group and Tom Lee at FundStrat predicted leadership will shift to small caps for the rest of the year. The economic news was mostly positive, with growth continuing as the Federal Reserve moves toward cutting rates. Core retail sales, for example, were better than expected in June, and May was revised higher. Housing data, industrial production, and leading economic indicators also surprised to the upside. Initial jobless claims and the Fed's Beige Book survey of economic conditions, on the other hand, reflected more softening. Chairman Jerome Powell said on Monday, waiting for inflation to slow all the way down to 2% could be too long. That seemed to confirm he wants to cut interest rates soon. The market largely expects the move on September 18th, with potential confirmation from the central bank on July 31st. Overall, the news seemed to confirm a potential Goldilocks scenario. Inflation isn't too hot and growth isn't too cold. That's often considered positive for risk appetite. Banks were the best performing group last week, as companies like Huntington Bancshares, Regions Financial, and State Street jumped to new 52-week highs. Huntington and State Street reported better than expected earnings, while Regions said net interest income will be near the high end of guidance. The moves are consistent with a trend of widening profitability in the industry. 15 months after the collapse of Silicon Valley Bank, housing stocks, energy, small caps, and real estate investment trusts also gained last week. Semiconductors, this year's top performers, dropped about 9%. Solar energy stocks crumbled on the prospects of a potential second Trump administration. Software and precious metals also fell. Warner Brothers Discovery had the biggest gain in the S&P 500 on reports it may divest assets or spin-off businesses. DR Horton reported better than expected quarterly results and announced a $4 billion stock buyback. United Health surged to a new all-time high after profit beat estimates. Despite the gains in energy stocks, crude oil closed at its lowest level in a month. The commodity potentially faces softer demand based on refinery data in China and the United States. Traders could also worry about the prospect of increased supply with an OPEC Plus meeting on August 1st. Reuters reported on Thursday that the cartel will probably allow production to increase, despite signs of weaker demand. Lower oil prices could potentially support sentiment over the longer run, because it would reduce inflationary pressures. And now let's chart the market. Last week's slide followed a moment of giddiness as sentiment reached the most bullish levels of the year, based on the American Association of Individual Investors weekly survey. The slide may have done some technical damage, while creating potential opportunities for trend followers. One negative was the bearish outside week. The S&P 500 hit an all-time high near 5670, before stalling and diving to its lowest level since July 2nd. That's a potential reversal pattern. On a more positive note, traders may notice that the relative strength index, or our SI, has dipped from an overbought condition. They may also look for support around 5,500 and the 21-day exponential moving average, which were both near Friday's close. And now let's turn to the coming week, which has big economic reports on Thursday and Friday. Earnings also get more active with about 1/4 of the S&P 500 reporting. Most of the companies are less prominent members of the industrial and financial sectors. Verizon Communications and Truist Financial report today. Tomorrow morning brings General Motors and Coca-Cola. Tesla, Alphabet, and Visa announce in the afternoon. Existing home sales are also due. Crude oil inventories on Wednesday morning could provide a potential catalyst for the commodity. Some of the big quarterly reports include Ford Motor, ServiceNow, International Business Machines, and Las Vegas Sands. Gross Domestic Product, or GDP, is on Thursday morning. It's the government's first estimate of economic growth in April, May, and June. It also includes potentially important price data. Initial jobless claims and durable goods orders are also due. Friday brings the Personal Consumption Expenditures Price Index. While often a key measure of inflation, it may have less impact this month because the market has a clear sense of upcoming monetary policy. Next week is the biggest part of earnings season, with results from heavyweights like Apple and Microsoft. There's also a Fed meeting. Thanks for watching. Please visit tradestation.com for more.